A prediction says what you hope the market will do. A trading plan says what you will do no matter what the market does. That difference is the line between reacting and operating. Most traders have a collection of ideas, indicators, and opinions, but no complete decision system. When pressure arrives, they improvise. This video will build a practical trading plan from the ground up. Setup, market condition, entry trigger, invalidation, size, profit management, no trade rules, and review. You do not need to predict every move. You need a process that keeps one surprising move from removing you from the game. Start by defining one setup in a single sentence, not 10 patterns. 1. For example, I trade the first controlled pullback after a strong breakout from a multi-day range. That sentence identifies the structure, direction, and timing. Add a visual checklist with 3 or 4 features you can recognize quickly. The purpose is not to capture every opportunity. It is to make your decisions repeatable enough to measure. If your setup changes every morning, your results cannot teach you anything. Mastery begins when the same question is asked often enough for the answers to become useful. Next, name the market condition your setup needs. A breakout strategy may thrive in expanding volatility and fail inside a slow, choppy range. A mean reversion setup may do the opposite. Check the broad market trend, volatility, volume, and nearby support or resistance. Then classify the environment with simple language: trending, ranging, or unstable. Your plan should explain which conditions receive normal size, reduced size, or no trade at all. This filter prevents you from blaming a good tool for failing in the wrong environment. Even the best sailboat performs poorly when there is no wind. Now define the entry trigger. A zone is not a trigger. Price reaching support tells you where to pay attention, not when to click. Your trigger might be a reclaim, a higher low, a volume expansion, or a break above a confirmation candle. Write it precisely enough that another trader could look at the same chart and understand your decision. Waiting for confirmation may mean missing some trades, but that is not a defect. The trigger exists to make the market prove something before you risk money. Your job is not to be first. Your job is to enter when the evidence matches the plan. Every plan needs an invalidation point. Ask what price action would demonstrate that the setup is no longer behaving as expected. Place the stop beyond that structural level. Then include a small allowance for normal noise if your market requires it. Never choose the stop by deciding how much money you feel comfortable losing and forcing that dollar amount onto the chart. The chart determines the distance. Your risk limit determines the position size. If the structural stop is too far away for an acceptable position, reduce the size or skip the trade. Reality does not negotiate with your preferred share count. Position size is where the plan becomes mathematics. Decide the maximum account risk for one trade. Subtract the entry price from the stop price to find risk per share. Divide the account risk by that number. If you can risk $100 and the stop is 50 cents away, the theoretical maximum is 200 shares. Round down for slippage and uncertainty. This calculation makes wide stops smaller positions and tight stops larger positions while keeping the account risk controlled. Size should be the final output of the plan, not an emotional vote on how confident you feel. Profit management also belongs in the plan. Decide whether you will use a fixed target, trail behind structure, scale out, or combine methods. Connect the target to realistic market levels rather than a fantasy number. Then compare potential reward with the initial risk. A trade offering 20 cents of upside and $1 downside is unattractive even if the chart looks beautiful. Plan what happens if price moves quickly, stalls, or nearly reaches the target and reverses. There is no perfect exit. The goal is a consistent method that captures enough of your winners to pay for normal losses. Strong plans include no trade rules. These rules protect you when your decision quality is weakest. Examples include no new position immediately before major economic news, no trade after reaching the daily loss limit, no chasing beyond the plan zone, and no entry when the stop location is unclear. Add personal rules based on your history. If your worst losses happen after 3 consecutive trades, create a mandatory break. A no-trade rule can feel like missed opportunity, but it has actually preserved attention and capital. The cleanest trade in your journal may be the one you correctly refuse to take. Wrap the plan inside a daily routine. Before the market, identify conditions, levels, catalysts, and the 1 or 2 setups you want. During the session, use a short pre-trade checklist and record screenshots. Afterward, review execution while the memory is fresh. Once a week, calculate the numbers: win rate, average win, average loss, expectancy, and rule violations. Do not rewrite the strategy after every red day. Change one variable only when a meaningful sample reveals a pattern. Your routine is the bridge between a plan that sounds intelligent and behavior that actually becomes consistent. A durable trading plan is not complicated. It is complete. It tells you what to trade when the environment is favorable, what confirms entry where the idea is wrong, how much to risk, how profits are managed when to do nothing, and how results are reviewed. Print it. Put it beside the screen. Grade every trade against it for 30 sessions. Profit will still vary because markets are uncertain, but your behavior will become far less random. That is the real purpose of a plan. Not to control the market, but to keep the market from controlling you.